Hey traders, welcome to Charts and Coffee. Hope everyone is having a good Wednesday morning. We are cruising into the last 2 days of the trading week. Tomorrow is options expiration for the month of April. So we're cruising into also the psychology of, and I don't look at necessarily max pain levels. That's usually reducing everything down to a single level. What I'll be doing today and tomorrow, looking at potential moves, is where are those really liquid levels of open interest, and where does price need to go? And this is the main question, to render the largest group of options worthless. Right? That's the plan. That's going to be sort of the bubble that we'll be operating in tomorrow. And today it's good to prepare for that bubble because of the unique volatility to that OPEX event. All right, that being said, in the meantime, we've been talking quite a bit about the overall weakness in the indices on the daily time frame. The downtrend is still very much in play, not the panic, but the overall downtrend. We sit right now at around 53.70. 53.70 is still a good bit below the 10% pullback. Remember that on the 7th of April, we got to and through that 20% pullback, and you can see we did it again on the 9th. So both the 7th and the 9th were those 20% pullback candles, and we're still operating just below 10. 10 to 20% is heavy, no doubt. But that in and of itself has to be looked at within the context of the overall trend, and that trend is indeed still down. I'm not looking for those panic-driven candles. Now we seem to be, and I'm going to measure this not based on what I feel or what I think, but rather on what I see. And we seem to be now, and it's been a long time since we've had this. We haven't seen this since since the announcement of the tariffs. We haven't seen normal price action movement in terms of historical volatility since the beginning of this month, and the last, including this one. So this candle and the last two candles were operating in that normal volatility. That means that trading with a realistic stop is back in play. Now, it's not as if we don't get setups and high volatility, but it's hard to manage the risk when we're so far outside even the second standard deviation of historical volatility, which is what we've been seeing for the first half of this month. So let's say you're trading the ES. You can't put in your typical 3-4 point stop on something like this and be able to hang on to what would ultimately be the follow through. So you might say, Rag, is that really then a setup? You're absolutely right if you're thinking that. For me, it's not. If I can't manage risk from the entry with basically the expectation of sort of normal price movement range that we see 68% of the time, I'm in that abnormal 32%. Risk management is a little bit of a Cirque du Soleil. I was thinking about Cirque du Soleil, watching some of this action. Very difficult. You've got to be an acrobat to do it. And my account is not a Cirque du Soleil account. And I think for traders who prioritize risk management like I do, it's okay to be flat. It's okay to be on the sidelines. Sure, trading this can be fun, but if I want fun, I'll do something else. If I want excitement, I'll do something else. I'm not looking for either one of those in my trading. Not that disciplined trading isn't fun. It actually absolutely is. And now that normal price action is returning, these are things that we're doing in the master. We're slowly getting into risk prioritized setups. We're long gold. We're focusing on the long side of gold. Got into that just the other day. And then we continue to manage a long Coke position, which we've already scaled out of. And now we're looking to see how much higher is high before expiration. So this one expires tomorrow. It's already paid us. We've already protected the downside. We've already skewed the risk reward in our favor. And now whatever happens at this point, this is a trade that is not, unless barring any gaps, which we all have to deal with, barring any gaps, this is going to be a relatively easy management into tomorrow. Around noon, I would think from a time-based perspective, if I'm not already target, in other words, profit closing or trailing stop closing this trade, it's done its job and we've managed risk. And at the end of the day, that is the job. All right. So with all that being said, let's see what else is going on in the broader averages. This time in the morning, 9 a.m., already 8 to 9, most of my focus is looking at the futures contracts because they're the ones that are open. They're the ones that are not pre-market. They're actually trading in their normal trading environment. There's volume, there's participation. There's not as much attention as there will be in about 25, 24 minutes, but this is how I get an early look at what it is we're seeing in terms of risk appetite or risk aversion. Crude oil continues to struggle. It's not in a downtrend, but once I get those 5 candles of whichever color, mostly focusing red and green. So in this case, the top tier candles have plotted the requisite 5 green candles. And the only thing that I can do is look at long puts triggered at resistance. And that's okay. The whole idea of a setup really is, if we think of setups as filters, and if we think of filters, what do filters do? A water filter. It's not adding things, is it? It's removing things. And our job as traders is to have a setup that says, look, if these criteria are not met, I'm not even thinking about it. And if these other 2 or 3 things happen, I'm not taking it. And I look at trading even from the perspective of have 2 or 3 reasons to take the trade, but have easily 1 reason where it's invalidated. My experience has been good trading is really a process of eliminating, not adding, right? And when you get to that point, you realize the cream naturally rises to the top. All right, I'm going to grab my drawing tools here, which I don't have. There we go. So as always, if you have any questions, phone lines are open for your requests. Feel free to type them on in. And let's jump on over to see what's going on with bonds this morning. So you can see here, bonds, much like crude oil, not in a downtrend, but do I have the 5 requisite red candles? Yes, this then to me is more of a environment that would favor long puts or short sells. Also, bonds, since that early part of the month and up until yesterday, right? Take a look. Outside the normal range, outside the normal range, outside. Up until yesterday, we haven't normalized and remained within that historical volatility. Now we have. Look, when we exceed historical volatility, it's not as if anything's broken. It's that we need to be able to differentiate between what's normal, which is what most of our risk management is based on, and what's abnormal. And I don't know how many of you saw the movie Margin Call. I highly recommend it. But if you don't want to watch it, there is, and you can find it on YouTube, there's a scene in the movie where the guy who he's one of their analysts, he's quite literally a rocket scientist, and he's telling his bosses, because he's just a low-level analyst kind of guy, he's telling his bosses that the risk that they've assumed, and this is loosely and not even that loosely, based on Lehman Brothers in 08. So he's telling them that the volatility in this case has exceeded what their parameters were built on. So the risk that they were ending up taking was built on those old parameters, and the risk that they're dealing with is nothing like that at all. It's far exceeded it. And this is when he says, look, we're doomed. We're operating like it's still normal, and we're outside the normal volatility, therefore outside their acceptable risk. And while that might be a bank, the whole movie is about the bank, we can learn a lot from that as traders. Are we in normal risk environments or not? Because if we're in abnormal, one, we need a real-time way to assess and measure it. So it's not enough to say this is high volatility. By how much more is it high volatility? And we need a real-time way to know when it's back in the normal range. So like I said, abnormal, abnormal, abnormal. Yesterday was the first day that it was normal. We can say the same thing about a number of symbols. And in this environment, that's really where a lot of my attention is. Large candles, if they're in the context of a trend, aren't as big a problem, especially an uptrend. So here's gold. You might say, Rob, we've rarely seen normal gold volatility candles since the 3rd of April. This is true. But all of this was happening within the context of a trend, including this mean reversion that happened on the 7th and the 8th. Since then, we've sort of started to slowly normalize. And I went ahead and said, look, I like the long call. I like the long gold futures position, however you want to take advantage of this narrative. But it was only until the 14th where things started to look a little normal in terms of a candle where we can find a trigger and have some reasonable expectation of our stop loss parameters being applicable. Because what's our choice otherwise, right? We could reduce desired account risk. That's one metric that we can reduce, which would naturally do what? Move the stop loss? No, it would actually reduce position size. So it affects negatively our account in a more manageable way. Those are the adjustments. What sadly most traders do in environments like this are completely abandon the risk management. They completely abandon the things that are really the principles of account growth, which is position sizing and stop losses. That's why environments like this are tough. It's not like you can't find trades. It's really more of, well, how do I know the trade is no longer valid? And how do I make sure I'm not exceeding my desired account risk? That's the language of account growth. And dare I say, the language of successful traders, right? And most of the traders that I know said, Rob, yeah, there's some opportunities here and there. We've been day trading or going to a very, very long term. So the last couple of weeks have been a focus on, say, 5-minute time frames and getting in and getting out and really freeing ourselves up to not care at all about what tomorrow is going to bring. Day trading is today trading, right? Or we go out to where we have the shock absorption and the opportunity with a much longer time horizon, meaning position trading for longer term positions. I mean, 6 months, a year, or greater, right? But things are looking much better halfway through the month. And as we've been talking about in Charts and Coffee, that's a function of this is not new news anymore. This is not really shocking anymore. There's only so many times when, anything. I mean, think of a scary movie. I hate scary movies, but think of a scary movie. At first it might be, oh my gosh. And then after a while, you know what's going to happen. And it sort of becomes a comedy, right? And I guess that's the phase we're in. We've already seen the monster jump out from behind the shadows a bunch of times. And now we're ready for it. It's not a surprise anymore. We've met the monster. And if you use good risk management, you survived it as well. All right, so let's get into some of the questions. Thanks for typing them on in. All right, how does XLV look for a swing trade? Well, those are going to be two different time frames for me. Either a 1 hour time frame, all right, a 1 hour time frame. So that's going to be a short-term swing. Overnight exposure, probably, but the expectation for movement in that window of opportunity is maybe 1 to 3 days. So I don't need a ton of time to expiration. All right, on the daily time frame, so I could be a little bullish, Ren. I could be a little bullish on the 1 hour, as you can see here. On the daily, it's bearish only. It's in a downtrend, red candle. So this is where if you're a short-term trader, you can be bullish. If you're a longer-term trader, meaning maybe a 2 to 10 day plus time horizon, you've got to be bearish. So that's where some of the difference is going to be. Time horizon and direction. It's not often that the 1 hour is going to trigger something markedly different than the daily in terms of direction. This is an environment right now where you'll see that pretty often. So it just depends on your willingness to commit to a longer term time frame. And let me get I have one of my windows telling me it wants my attention. Let me just close that. Okay. There we go. All right. So that is the way I would look at XLV. And again, if you think about risk in both these situations, I'm going to likely have the ability to risk a little less of my account in terms of the hourly, because I can have probably more aggressive initial targets. And I know that's a different way of thinking about targets. Most people think target, they think about making money. The first target for me is actually the first step of risk management in a lot of ways. In other words, at what point within the life cycle of your trade, and everyone should have this, are you skewing risk management in your favor, right? What point in your trading life cycle are you reducing the risk to your account? And that's really the process of also growing your account. Yeah. I see a lot of traders who have the chutes and ladders idea around risk management. And that's why they have big wins, they have big losses, and their P&L kind of looks like a roller coaster or chutes and ladders. But if you think about position sizing, and the mindset you have is how much of your account are you willing to risk? For a lot of traders, that's 10%. I will tell you that's untenable. And if you go back and I do too, and you listen to the legends, you listen to folks who've been doing this. I've been doing this a long time, and there's folks who've been doing this longer than I have. And we all will say the same thing. Really, you never want to be risking ever more than about 5%. And that is an idealized, uptrending, full market participation type environments. 10%, no way, right? And that's what a lot of traders unfortunately do. So a little bit of this is going to be a risk management conversation. Did my mouse just die? Yeah, my mouse just, wireless mouse. All right, but we are the Sector Secrets Mastery, redundancy. All right, here we go. There's my backup mouse. Okay, thanks for the question, Ren. All right, any chance gold is parabolic? All right, so parabolic for me, let's define it, right? Parabolic is definitely just another way of saying an accelerated market, typically up or down. So there's a trend, and it's leaping higher. Is gold parabolic? I will say yes, but it doesn't make it any less tradable, just more volatile. Gold is, I would say yes, it is parabolic. When would I say it's parabolic? It's the distance between the current candles and the mean reversion. So I look at a specific distance between where, so for example, the first sign that gold was parabolic was, for me, probably the 19th of March. And it's been that way ever since. We had a mean reversion. And then once again, that distance between current price action and the mean reversion, which, by the way, on this screen is the green, yellow, and red lines. Those are the mean reversion lines on my chart. Yes, it is based on that. And, thank you for the question. For all of us, we have to have a way to measure, right? It can't just be, it looks like, it feels like, or look at that big candle. We've got to bring it down to a measuring stick. And that's my measuring stick there. All right, let's see. Do I have any shorts in my book right now? Jas, I do not. I do not have any shorts on my book right now. Let's see. Eddie says, yep, I agree, Eddie. We all are going to lose, right? Although, look, some people don't ever lose, right? They defend, they roll, they add, and then they just sort of stop talking about it. I love talking about losses. Everyone knows the mastery. If I have a loss, gosh, I'll spend 3 times as much time talking about the nuances of managing risk and losses than I will a winner. We don't learn anything when we're winning. There's a lot for traders to learn from an experienced trader saying, hey, this is the trade we took. This was the stop loss. It didn't work out. And I agree. Risk management is how, not only, I like the way you phrase that, allows you to trade tomorrow, but risk management really is the key to account growth. And I know it might seem counterintuitive, but it is the only way, right? Okay, let's see. Next up is, I feel good when I take a loss. Jas, I'll tell you what, is it good? Is that weird? It is fantastic, because taking a loss is discipline. And, as Jocko, I don't know how many of you listen to Jocko Willink, that is freedom. Discipline is freedom. I'm freeing myself up from the burden of something that's presenting too much risk, right? How many times in life can we just say, had enough of that, close the trade out, I'll move on to something new? Life isn't always that easy. I can't just say, nope, don't want that anymore, cut it. But in trading, we can, right? So is that weird? It feels good. Doesn't it feel good to drop the burden? I think it does, because it frees up mental capital. It frees up emotional capital too. So is that weird? If weird is awesome, then I'm with you. I'm weird too, Jas. I agree with you. I totally agree with you. Okay, next up is questions. All right, let's jump on over to, let's see. I looked at crude, we did look at gold. Crude gold bonds. We looked at the EFs. Let's take a look at the NQ this morning. All right. So on the NQ, yes, we have the downtrend. Yes, we have the bearish chop on the 1 hour. This right here are notes from the NASDAQ when I do a scan within that group of stocks. Apple, Meta, Google, and Cisco are all in downtrends within this index. And then I could look specifically at whether or not XLK, XLC, XLY, etc. are. So that's where we sit this morning, gang. As always, thanks so much for being here. I will see you all tomorrow, same time, same station. Be good to each other.